This is the second biggest bank failure that's ever happened in the United States.
Biggest bank collapse since the 2008 financial crisis, and it shut down today. It's called Silicon Valley.
Silicon Valley Bank in just 48 hours is the second biggest bank collapse in U.S. history, and it sent shockwaves from...
Hello there. In this video, we'll be discussing the collapse of Silicon Valley Bank, one of the largest banks in the United States. After the collapse of Lehman Brothers, which was the fourth biggest bank in the USA back in 2008, Silicon Valley Bank is now considered as the potential trigger for the next great financial crisis. We'll explore the factors that led to the bank's failure, as well as the impact it had on depositors and investors. Silicon Valley Bank saw massive growth between 2019 and 2022, which resulted in it having a significant amount of deposits and assets. While a small amount of those deposits were held in cash, most of the excess was used to buy treasury bonds and other long-term debts. These assets tend to have relatively low returns, but also relatively low risk. But as the Federal Reserve increased interest rates in response to high inflation, Silicon Valley Bank's bonds became riskier investments. Because investors could buy bonds at higher interest rates, Silicon Valley Bank's bonds declined in value. As this was happening, some of Silicon Valley Bank's customers, many of whom are in the technology industry, hit financial troubles, and many began to withdraw funds from their accounts. To accommodate these large withdrawals, Silicon Valley Bank decided to sell some of its investments, but those sales came at a loss. SVB lost $1.8 billion, and that marked the beginning of the end for the bank. March 8th, Silicon Valley Bank announced its $1.8 billion loss on its bond portfolio, along with plans to sell both common and preferred stock to raise $2.25 billion. In the aftermath of this announcement, Moody's downgraded Silicon Valley Bank's long-term local currency bank deposit and issuer ratings. March 9th, the stock for Silicon Valley Bank's holding company, SVB Financial Group, crashed at the market opening. Other major banks also saw their stock prices take a hit. Additionally, more SVB customers began withdrawing their money for a total attempted withdrawals of $42 billion. March 10th, trading was halted for SVB Financial Group stock. Before the bank could open for the day, federal regulators announced they would take it over. After regulators were unable to find a buyer for the bank, deposits were moved to a bridge bank created and operated by the FDIC, with a promise that ensured deposits would be available by Monday, March 13th. March 12th, federal regulators announced emergency measures in response to the Silicon Valley Bank failure, allowing customers to recover all funds, including those that were uninsured. March 26th, First Citizens Bank bought all of Silicon Valley Bridge Bank except for $90 billion of securities and other assets that remained in FDIC receivership. Impact on depositors and investors. Silicon Valley Bank's depositors are insured by the FDIC for up to $250,000 per account category, so depositors with $250,000 or less would receive full reimbursement. However, as most accounts held more than $250,000, the uninsured portion of funds would be lost in the event of a bank failure. In summary, Silicon Valley Bank failed due to investments in long-term debt and financial struggles of its tech clients, leading to a loss of $1.8 billion and bankruptcy. This event had a ripple effect, causing other banks to fail and shaking investor markets worldwide. Thank you for watching.